we're likely to see the banks starting to fall. I'm looking at, for example, I put on Twitter the long-term chart of Citibank. Looks like the cliff of death. Looked like all of the European banks did. I've been looking at Bank of America. Doesn't look great. And then the regional banking index, the KRE. So that would be a tipping point that would start changing the equation. What else can uncouple markets? Well, the bond yield issue in itself can uncouple markets. But what it's telling me is we're getting closer to more cowbell.
Renowned macro guru Raoul Pal believes we are about to have an interesting turn of events with regard to the United States economy and markets in 2023. It's been about 17 months since the U.S. Federal Reserve started its aggressive rate hike campaign in March 2022. Last year, the central bank announced a bunch of jumbo rate hikes, including 4 consecutive 75 basis point rate hikes, specifically designed to slow down the economy and lower the 40-year high inflation recorded in June 2022. Though the central bank is threatening more rate hikes and a longer period of rate cuts while the Treasury Department continues to assure the public that the U.S. economy remains strong, experts are certain that several sectors are already beginning to show signs of severe cracks. One of the sectors Powell believes has been seriously impacted by the Fed's aggressive rate hikes is the banking sector. According to the Real Vision chief executive, there are clear signs that the regional banking sector crisis that took out multiple smaller lenders earlier this year is far from over. During a recent video broadcast titled Ask Me Anything with Raoul Pal, the renowned macro analyst discusses his outlook on the state of the U.S. economy, especially the ailing banking industry. Last Monday, S&P Global Ratings cut ratings on some regional lenders with high commercial real estate exposure. The banks affected include Associated Bank Corporation, Valley National Bancorp, UMB Financial Corporation, Comerica Bank, and Key Corporation. For the first two, the rating agency cited funding risks and higher reliance on brokered deposits as reasons for its actions. For the other three, it cited deposit outflows, higher interest rates, and constrained profitability. The ratings agency's actions came weeks after similar downgrades by Moody's, another major credit rating agency. Moody's cut the outlooks for U.S. banks, including Capital One, PNC Financial Services Group, Fifth Third Bancorp, and Citizens Financial Group. It also put several others, including large lenders, on review for downgrades. The ratings agency noted that the U.S. banking sector is facing several sources of strain, such as funding pressures, regulator capital weaknesses, and rising risks associated with commercial real estate exposures. According to Powell, there might be more banking sector collapses or takeovers and general weakness in the industry, which will incentivize the Fed to turn on the printers again. The macro guru describes the potential reversal in the Fed's monetary policy using the popular internet parlance, more cowbell. Powell says we could see a major reversal in the Fed's strict policies as soon as the final quarter of the year. He is also looking forward to significant rallies in the cryptocurrency markets, spurred by the end of the summer holidays and even the slightest hint that the Federal Reserve is done hiking and will soon begin cutting rates. We will now bring you clips from the broadcast as Powell discusses his full outlook for the markets and economy, as well as his 3 top trades for the coming cycle. But before we do, don't forget to smash the like button, subscribe to the channel, and turn on post notifications for more videos like this. Also, ensure you drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and significantly contributes to the channel's growth. Thanks, and enjoy the video.
Markets are just sloppy. There's nothing really going on. There's no new money around. Everybody's in the Hamptons. All of that kind of stuff is going on. So you have to be patient in summer markets. And usually, once you start getting through August, September, things start kicking off. The things that I'm looking to kick off are, as rates have been decoupling from the market. So I actually got stopped out of my bond trade. Finally, I got out of that bloody pain. It was terrible position because bonds basically decouple from the business cycle this time around. It's nothing to do with inflation. It's actually to do with liquidity because of how the Fed are, the Treasury are issuing so many new bonds to pay the interest on the bonds because rates are so high. They're doing it in the bills market. That's draining the reverse repo, but it's still flowing through into the rest of the bond market, and yields have been rising. That whole process has started pushing the banks lower again. So I'm keeping my eye on that. But what it's telling me is we're getting closer to more cowbell. That point where the Fed have to go, oh, and that happened last time, if you remember, in December 2018, when suddenly the repo market broke and the Fed was like, we're stopping QT, and we're not going to hike anymore. And then they started cutting 6 to 9 months later. We're in that phase, I think. Let's see what Jackson Hole has. Powell still thinks he's Volcker, and it's a ridiculously different environment. But that's what they want to believe right now. So my guess is that the payback for this is, I think they're going to undershoot inflation. So I'm strongly of the opinion inflation is well below 2%, maybe even as low as zero by the end of the year. And that's been my call for a while now. And I think core inflation goes to zero by summer to this time next year. So I think we've got all of the inflation domino to play out from the GMI business cycle dominoes. We have, I think, a rise of unemployment will come over this period. I don't think it's going to be huge because there's some complications in the labor market as people are leaving the labor market, etc. And I think rents are coming down, all of that stuff. So what we're likely to see is the Fed going, "Oh my God, sorry, we've undershot," which gives them the cover to cut rates, which they need to do because they cannot pay the interest on the debt at these levels ongoing. They've got about 13 trillion of debt to roll over plus new issuance. They need to get rates lower, and they need to then monetize the interest payments. That's part of the Everything Code thesis, those of you who've been following along at home. So the Everything Code thesis suggests that Q4 is going to be when this start of action starts happening, and we don't, maybe QT stops, maybe we get a rate cut, maybe we don't, but we start flagging it, and then we start to see, I think, another leg of the economic slowdown. I think we're actually bouncing out the forward-looking indicators of ISM, all of this stuff I've been talking about in pro macro on Real Vision. That's where you get all the juicy stuff. So you guys watching this, most of you are pro macro subscribers, so you don't get all of the research that I put together, but we do a lot of stuff. And that's suggesting that we are going to seeing a sharp economic rebound. That was forecasted by liquidity and the GMI Financial Conditions Index. It is starting to slow down a bit because of these yields and the dollar stabilizing. And so that suggests that Q1 next year, so we might get a pickup in growth at the end of this year. Now, that won't come into GDP. GDP's lagged. Everything kind of lags in this. So GDP should be weaker in Q4. I know that the Cleveland Fed have this ridiculous 5.9% number. That'll go away. But we should see GDP low, but the forward-looking indicators, stuff like ISM, start to pick up. And then we might get another slowdown within Q1, but I think at that point the market is more focused on the cowbell.
Like Powell, several prominent analysts and economists are also predicting a rate cut during the first or second quarter of 2024. According to a National Association for Business Economics (NABE) survey, economists are estimating a rate cut from the Federal Reserve during the first quarter of next year. Goldman Sachs Group economists are not as optimistic. According to recent reports from Bloomberg, the financial services institution is anticipating that the Fed will start lowering rates by the end of Q2 2024, with further cuts in every succeeding quarter. According to the report, the economists believe that the cuts will be driven by the desire to normalize the funds rate from a restrictive level once inflation is closer to the Fed's target. A recent Bank of America Global Fund Manager survey shows similar expectations. According to the survey results, participants expect the first FOMC rate cut to be towards the second quarter of 2024. Whether the cuts come in the first or second quarter, just a small hint that the Fed is willing to be less aggressive could spur instant rallies in the cryptocurrency market. Let's get back to the interview as Powell further discusses his outlook on the economy and gives his top 3 trades for the next bull cycle.
And then we're into the full election year, and the full election year is cowbell central, because then you've got stimulus to try and bribe the voters, rate cuts to bribe the voters, the use of the balance sheet to try and not get the Treasury to end up with ridiculous debts on their trying to issue ridiculous amounts of bonds and the market not being able to do it and crowding out the private sector. Sorry, I'm speaking very fast because there's a lot in the Everything Code and I can't really get it across in a very short thing. Anyway, all to play for. Q4, when it gets interesting, everyone needs to get back from holiday, and then we can see from there. David Kelly, afternoon, Raoul. How do you see real yields playing out? Well, real yields are a real issue. They're too damn high. I mean, they're super high right now, and that is going to continue to erode inflation and economic growth going forward. So my view is that countries high in debt cannot run long-term positive real yields, and that the trend rate of real yield is probably negative 1%. So I think in the next cycle we go back to trend rate of real yields, and I think that's that is the only way you can get around an aging population with massive debts. And we see that all over the world. Raoul, John Kitchener, I'd love to hear your thoughts on Citi. I don't know, but I've used these very long-term charts of banks since the European crisis in 2012. And I've called it the cliff of death. And one by one, many of these banks have gone over the cliff of death and they've needed to be bailed out. What it was the Italian banks, the Spanish banks, the German banks, the Swiss banks. And there still seems to be an ongoing rolling thing. It's like the broken banking system globally. And Citibank is one of those. It just looks like that. It never recovered. I mean, it just fell like a stone and then has been trading sideways ever since. And that cliff or that plateau feels like it just wants to jump off that. So I don't really know what, well, we know why. Rates are too high, the yield curve's inverted, the banking system's not fully functioning, et cetera, et cetera. So there's a lot of reasons why not to like banks, but cyclically at this point, they should start to improve once the yield curve improves. Banks aren't always negative, and as soon as we start to get the yield curve steepening and rates coming, then banks tend to do okay. So that's usually fine. What are your top 3 trades? John Floyd. John, my trades, I'm not a trader really. I think you've probably figured that out by now. My time horizons are very long. So for me, it is number 1 crypto over my time horizon. Let's just use this business cycle, not even going further out. Let's say over the next into end of 2025, I think crypto is the best performing asset in the world. I think technology stocks are number 2, and number 3, tricky, could be something commodity related, copper. Let's go with copper.
The Bank of America Global Fund Manager survey further reveals that 60% of the participants are expecting weaker global growth, 68% believe the U.S. economy will see a soft landing, while 21% anticipate a hard landing. 48% of the fund managers are also anticipating a global recession to begin in the first quarter of 2024, while 25% believe it will start much sooner in the final quarter of this year. And there's the risk of more weaknesses in the banking sector. After last week's ratings downgrade, the stocks of major banks which were not mentioned by the S&P fell. JP Morgan and Bank of America fell by almost 2%, while Citigroup, Wells Fargo, Goldman Sachs, and Morgan Stanley lost almost 1% of their share prices. Yet there are further downgrades on the horizon for the U.S. banking industry. Earlier this month, a Fitch Ratings analyst said the credit agency is looking at not only downgrading major and regional lenders it covers, but also lowering the industry's overall ratings. How do you think these downgrades will affect the banking industry and subsequently the overall economy? Please drop your replies as well as your comments on Raoul Pal's interview in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.